The gold sector, the senior gold producers, the sector's been sort of trying to repair its reputation over the past few years. The last cycle, capital discipline didn't exist. There were a lot of mine builds and M&A activity that really didn't add value. And a lot of companies have spent much of the past 10 years basically repairing their balance sheets. Growth in this context has become a dirty word, replaced by capital discipline. And as part of capital discipline, returns to shareholders has become part of the paradigm. At the same time, ETFs have become more important and more prominent, and they compete for investor dollars. And for a lot of investors, putting money into an ETF is a much simpler way to get exposure to the gold sector than investing in individual equities. Royalties and streamers, very similar. Investors can get exposure to a basket of assets without necessarily all the risks involved in investing in a specific company. More recently, there's been competition. The gold companies have had competition from cannabis stocks, more recently from crypto. Also, the general stock market has been, until recently, on a tear, so people could get very good returns just investing in the S&P 500. And more recently, until recently, the US dollar has been very strong. So again, another big source of competition for the gold sector in general. So all of these things considered, the gold sector has in some ways been losing investor appeal. But there is an opportunity here. We're now moving, many commentators, and you've heard this a lot at this event, with many commentators think we're moving into a cycle of higher gold prices, which for the gold producers means growing margins. Up until recently, we're in a very low interest rate environment. Obviously, the inflation the past couple of years, that's now no longer the case, but it has been a key factor up until relatively recently. So all of this, again, is feeding into the desire for gold companies to increase returns to shareholders as a means of attracting investments and investors and rewarding those investors. Quantitative easing and debt, the US dollar now weakening, gold is becoming a more attractive space to invest in. So this, in some ways, has led to a sort of dividend race, what I've called a dividend race. Here you see a chart showing how, since 2020, how gold companies have been stepping up the dividends they pay, and an increasing number of gold companies are paying dividends. Over that period of time, 2020 till today, the total returns of gold companies is increasing. In the blue bar is dividends, and the orange bar is share buybacks. So you can see a very palpable increase in the amount of cash that the gold companies are returning to investors. As a side note here, I think it's quite interesting that share buybacks have increased, because in many ways share buybacks reward investors for leaving a stock, whereas dividends reward investor for staying in a stock. So it's interesting to see, different companies have different approaches. And with dividends increasing, and bearing in mind that last year, March, April, May, the gold sector the gold equities had a bit of a downturn. Even blue chip gold companies suffered a 50% fall, up to a 50% fall in their share prices. Obviously, smaller companies, many suffered a 75% fall in their share price. But that falling share price plus increasing dividend payouts has seen the yields really grow. This is from data from January here, and you can see there are some very attractive levels there, up to 4 to 5%. And so makes an interesting situation with Barrick and Newmont paying over 4% yield, having a 4% yield. These companies have also started engaging in the practice of giving 10-year production guidance. It posits the question, are these now sort of unicorn stocks? And why do I say that? Because the yields are getting so high, they outcompete US Treasuries. Doesn't matter what the time frame is, whether you're looking at a 2-year Treasury, a 5-year Treasury, a 10-year Treasury. The leading gold stocks in this context are giving a better return than Treasuries. I mentioned at the start that gold equities have been receiving competition from other investment classes. I mentioned the gold and the streaming companies. Now, these companies have been very successful because they get exposure to gold, they get gold production, they have very, very low overhead. They don't have any of the risks of mining and operating a mine. And their share prices have been very strong. They've been very attractive from that point of view. These companies pay dividends as well. But as this chart shows, their share prices are so strong, their market capitalization is so strong that their yields are really quite or less attractive. They're not as attractive as what one can get from some of the gold producers. Now, all things considered, though, I think if you're a gold company and you're paying a yield of 4 or 5%, that's potentially very attractive to investors. If you're paying a dividend and your yield's 1 or 2%, one could argue, what's the point? You're not necessarily as attractive enough to attract investment. You're certainly not competing with the yield on a US Treasury, but you're draining your Treasury to pay these dividends. You could argue you'd be better off, a company would be better off putting that money into growth, into exploration, into building mines, or even engaging in mergers and acquisition. So I think there's some companies are neither here nor there. And this is the conundrum. And I think this is going to become a more pressing conundrum. As we go into a cycle of higher pricing, we're going to see producers increasing their cash generation. Over the past decade, they've been paying down debt. Debt is going to continue to decline and be paid down. Capital discipline is very much still in place. Companies are showing that they're starting to get a check on cost inflation. So I think we can expect to see margins expanding. So companies are going to be putting more and more cash onto their balance sheets going forward. And so what do they do with that cash? Are they going to continue to increase their dividend payouts? Are they going to invest in exploration, reserve replacement? Are they going to invest in M&A? So I think there's a lot of interesting things potentially going on, and that we'll see play out throughout the rest of this year. Thank you.